What's going on, everybody? It's Kevin Lau here for another edition of the Whiteboard Fireside Chat, and I am plowing through another whiteboard today. This is two in one day. I'm super pumped. Just a little bit fired up right now. I'm just seeing a lot of talk on the internet, on social media about life insurance and about permanent life insurance, and it's very divided. You've got these life insurance cowboys out there just slinging these products, like they're the best thing since sliced bread. And then you've got the other side of the equation, which is a bunch of fee only advisors or quote unquote fiduciaries. And, mind you, I'm one of them. And a lot of these people are my friends and my colleagues and my partners in this journey. But a lot of them love you to death, don't know anything about life insurance. And they're automatically just saying, nope, no permanent life insurance, just buy term and invest the difference. Or once you get to retirement, you're going to be self-funding your life insurance needs. And so therefore you don't need life insurance in retirement. That's why I'm going to the drawing board here, ladies and gentlemen. I want to break this down for you, and I want to talk to you a little bit about the different types of life insurance. Okay, so if you're in that 50 to 60 range, and you're saying, "Oh, hey, you know what? My term is about to expire in 5 years or in a couple of years. Do I renew this term? Do I convert it to permanent insurance?" Right? Or hey, there's a bunch of different products on the permanent side that maybe have long-term care riders on them. Maybe that satisfies my long-term care need. So there could be some reasons that you may want to have life insurance in retirement. Not necessarily that you need it, but you may want it. Okay. And just full disclosure, I used to sell life insurance. All right. I started my career in 2008 working for one of the big mutual life insurance companies. I drank the Kool-Aid. Okay. I still have my permanent life insurance policies. I was my biggest client. At one point in time, I was pumping $1,800 a month in my 20s into my whole life policy, and I didn't even have a Roth IRA. All right. And so I share that with you because I've been on that side of the table where I was selling these products to clients. And then now I'm on this side of the table where I don't have my insurance licenses anymore, but I am a fiduciary. I do work as a fee only registered investment advisor. But that's why I feel like this conversation is so important because, you know, of course we all have our biases. All right. Now, no question. I have my biases. Okay. So I just want to put that out there. But ultimately, I feel like it's so one, you know, all in this way or all in that way. And I'm just here to tell you that there could be reasons that you may want to own life insurance in retirement, and there could be reasons that you can completely drop your term policy or cash in your whole life policy or convert that whole life policy to long-term care insurance and forget about it. There could be reasons for both, and neither is right or wrong. It's all dependent on your unique circumstances, your financial situation. Okay. So I'm going to break this down. Why don't we go to the whiteboard here? Oh, and by the way, so this is going to be on should I own life insurance in retirement? All right. And then I'm going to touch a little bit on the different types of permanent insurance. I'm obviously going to do a little breakdown of term and permanent because by nature, if you want to have life insurance in retirement, it's going to be a permanent policy, most likely. But yeah. So next whiteboard I break down, which is probably going to be in about 30 minutes, I'm going to break down the differences between those different whole life policies or permanent life insurance policies, I should say. And hopefully that helps you as well. So make sure to check that one out. But in the meantime, let's get to the drawing board here. All right, so here's the question. Should I own life insurance in retirement? That's what y'all want to know. All right, fun topic here. So why don't we dive in? Why don't we dive in? Start with term insurance. All right, this is the easy one, and the way I like to explain it, the way I used to explain this when I used to sell these policies, is that term is like renting your life insurance. Okay. So you have it for a set period of time. And at the end of that lease, at the end of that term, the insurance goes away. And if you still need or want, notice how I continue to say need or want, because sometimes you may want to have life insurance in retirement because you need it. Sometimes you may want to have life insurance because you want it. And we're going to break those down for you. But if you are renting your policy and all of a sudden you turn 60 years old and now that term expires, the lease goes away. And if you still wanted life insurance at that point in time, you have to send a new application in. You've got to go through the underwriting process. Oh, and by the way, when you bought the policy when you were 30, you're going to now have to reapply at age 60, okay? Because now that 30-year term has expired, you're getting a new policy altogether that's going to be at your new attained age, which is age 60. And hopefully, you don't have any pre-existing health conditions, which most 60-year-olds that I know have something going on, taking some medication, or maybe there's a diagnosis recently. And so getting life insurance in general at 60, pretty difficult. But if you can qualify, great, okay? But better yet, if you do want to have permanent life insurance in retirement, it's best if you have a term policy that you can convert to permanent insurance without having to redo the medical exam. All right, so just a little food for thought there. If you've got a term policy, figure out what those convertibility windows are. Is there a certain age where it's no longer convertible, or a certain time period in the policy, that the convertibility window is up. But really simply put here, I mean, it's very simple. You've got a death benefit. Let's say it's $500,000. And this pays out if you die in that term. And sometimes you've had terms that are 5 years. Sometimes they're 10 years. Sometimes they're 20 years. Sometimes they're even 25 years or even 30 years. Sometimes they last until a certain age. That's called annually renewable term insurance. This is very popular amongst the big mutual companies. They sell this annual renewable term policy, and they hope you convert it later on because the cost of insurance just skyrockets over time. But the one I want to focus on are these level term policies, whether it's level 5 years, 10 years, 20 years. Okay. And essentially, you've got this death benefit of 500,000, and let's say it's a 20-year term. At year 20, the policy goes away. No more life insurance, and that may be just okay with you. That's exactly why you purchased it, not to die, but to outlive the term. But all along the way, you had that protection in place where if you did predecease your spouse, they were able to stay in the home and pay off the mortgage and put your kids through school or replace your income. All right, so that's why you bought the term policy in the first place. I have a lot of term insurance, okay? And I am very happy with that. It makes me sleep well at night. And if something happened to me, I know my wife, she can continue to stay home with our 3 boys and continue to, be there for them and not, have to go back to work. But at some point in time, hopefully I'm able to self-insure or self-fund a premature death. And maybe that's you. Maybe you took that policy out at age 40. Okay. And now you're sitting here at age 60. I should be doing different colors, right, Roberto? Come on. I love how I assume Roberto, one of my colleagues, just watches every one of my videos. I know that's not the case, but here we go. So age 60, so you bought this policy by design to expire at 60. And the nice thing about term insurance is just so inexpensive. It's pennies on the dollar because 97% of these policies never pay a death claim. All right. And so that's why they're so inexpensive, because the life insurance companies, they have this dialed in. You might be thinking, oh man, this is so inexpensive. The reason is because you are literally throwing money away for that peace of mind. And of course, if the unthinkable happened, if that tragedy did occur, of course, now you have that protection. Now that death benefit is going to be paid out to your beneficiaries. Oops. Tax free. Okay, so that's the big draw there. Life insurance has those tax benefits, and if something were to happen to you, that $500,000 will go to your beneficiaries tax free. So that's term. I mean, very, very simple. Okay, so I went over to my buddies at BC Brokerage. They do a phenomenal job. If you are a financial advisor, a fee-only financial advisor, watching this video and you're looking to partner up with a team on the life insurance front and annuities front, highly recommend BC Brokerage. They are phenomenal. And what I love about them is this is all they do is insurance. And so they're not going to come in and try to take over the relationship, the financial advisor relationship. But they have a financial planning mindset, when they're implementing insurance. So that's why I love them. But anyways, I went over to their website. I just wanted to run some quotes for who is this? This is for a 60-year-old. Okay. So this is a 60-year-old in really good health, by the way, and a male. So 60-year-old male in great health. But to buy a 10-year policy, like let's say you did want to have life insurance, maybe you have a mortgage still, and you're like, hey, I'm 60, I still have a mortgage. I might have this for the next 10 years. And if something happened, I'd love for my spouse to just be able to pay that off with a lump sum. Maybe you want to have some life insurance for the next 10 years to protect against that premature death risk. And look at the coverage here, $500,000 for a monthly premium of $112 a month. I mean, it's just pennies on the dollar. So just that's why term insurance is so inexpensive, because guess what? A 60-year-old male, life expectancy is 82. So that's 22 years. So the insurance company knows you're pretty likely to outlive 10 years. And that's why they price it accordingly. All right. But I just wanted to point that out because term insurance is just so inexpensive. And so just to get the adequate protection you need, it's very easy to solve that. So that's term. All right. So we've got the 5-year term, the 10-year term, the 20-year term, the 25-year term. Really simple. You're leasing the policy. When the lease is up, no more insurance. And then you choose to either buy a new policy, convert the existing policy, or just not have life insurance, which again could be completely acceptable. Okay. So let's talk about permanent insurance. All right. So permanent insurance, on the other hand, the way I used to explain this to customers I would sell these policies to, it's like owning your life insurance. Okay. So instead of you renting the policy, you own it. And it's kind of like owning a home where you pay a mortgage and that mortgage will continue usually for a set period of time. It used to be the old school life insurance. It used to be where you actually paid. The reason it was called whole life is you actually paid for your whole life. And they expected you to live until 100. And then so you would pay it that long. And then whatever the death benefit is, let's say it was $500,000, that's going to be in force whenever you pass away, whether that was at 100 or at age 90, whatever it is. It's going to be in force as long as you've paid the premiums. There's a death benefit in place. Now, there's also a living benefit associated with whole life insurance. Oh, and real quick, um, many whole life policies these days you can pay up before age 100. That's what I was actually going to say. Is many policies you can pay up in, let's say, 10 years or 20 years. And by fully paid up, I mean you don't have to pay another dime into the policy. There's enough cash to support the policy for as long as you live, and essentially you're done. Or by design, you're contractually not able to put any more dollars into the policy because then you're going to have more cash value than the death benefit. So there are limits in terms of how much you can fund these policies. And if you design it the way I'm talking about, you could have it paid off at a certain age. Some of the policies are paid up at a certain, a certain time period. Some policies are paid up at a certain age. So let's call it age 65. So you can design this so many different ways. And if you're buying it at 60, you're going to have limited options, whereas if you're buying it at age 50, there's a lot more flexibility and you can get a lot more death benefit, which could be important to you the sooner you buy it, because the life insurance policies are always based on your attained age at the time you apply. And also we talked about the pre-existing health condition. So always keep that in mind. Okay. Now, the big sizzle that I hear a lot of these agents pitching out there is this idea of these living benefits and this tax-free retirement income, LIRPs, life insurance retirement plan. Okay. And I think for the right client, I'm not going to say it's wrong, but for the right client, sure, I could see the value in potentially looking at this at a permanent life insurance policy. And again, I have permanent life insurance myself. I elected on purpose not to cancel my policies once I left the insurance side, did my CFP program. I said, hey, you know what? I see some value here, and I'll talk about what those reasons are in just a second. But you're also going to accumulate some cash value that you could tap into at any point in time. And with whole life insurance, you're going to have a fixed rate. But the key is you're going to have a fixed, see with this COI, you're going to have a fixed cost of insurance. Okay. So if I take my little marker here, and I've already drawn a line here, and so this is already the line I'm drawing, and I'm just going to draw the same one because it's orange, and that's what I'm referring to with whole life, is the COI, or the cost of insurance, is going to be level on whole life insurance. I'm going to say that again. The cost of insurance is going to be level with whole life insurance. So it's contractually designed where you don't have to do a lot of thinking on this one. They have a set premium. You're going to pay that premium for 10 years, for 20 years, until age 65, until age 100, whatever the contractual agreement is up front. Now, of course, there could be some flexibility along the way. Maybe you use some dividends to pay the premium, or maybe you take some of the dividends as cash, or maybe you add a lump sum. An additional premium is what you would call it. You add a lump sum to the policy to kind of juice it up a little bit in the beginning, or add lump sums on an annual basis to the policy. So there's different ways you can massage it. But what I'm saying is, and why it's so important to distinguish between whole life and universal life, is the cost of insurance. So how does the cost of insurance work for a universal life insurance? Okay. Well, it's going to be based on your attained age on an annual basis. All right, so an age 60-year-old, the cost of insurance might start here. And then at 61, it might go up a little bit. Or not, it will go up a little bit because you're going to be 1 year older. And then it's going to continue to do that. And it's going to continue to go up gradually over time. And at some point, it's going to cross over. Okay. And then it gets really expensive. All right. And you may have heard the terminology. You may not have, probably, because you're not a life insurance weirdo nerd like I am. But you may have heard the terminology surrender squeeze or policy lapse. And why that happens with universal life insurance is because the cost of insurance is not fixed. So these life insurance cowboys out there slinging policies in the 70s and 80s, what was going on in the 70s and 80s? Hyperinflation. Interest rates were double digits. Okay, so what was in the illustration initially that they were showing to all of you that are now 60 years old? Showing 10%, showing 12%, maybe on the low end, 8% a year. And what happened to interest rates over time? Drop down. So where are we sitting now? Low interest rates for the last 16 years. I know obviously they've gone up over the last couple of years, but for a long time, 14 plus years, we had historically low interest rates. So what happens when interest rates drop? The insurance companies, they can't pay the same dividend any longer that they illustrated initially on your policy. So the dividends are then going to go down, but the cost of insurance continues to go up. And so what happens is the cost of insurance eats away at your cash value, or could eat away at your cash value if the policy wasn't designed properly. And that's what I hear this jargon thrown around all the time with agents is designed properly. What that means is you have a game plan to pay not only the cost of insurance today, but account for the fact that universal life is going to go up over time, and you must pay for that up front in advance. Get the policy juiced up, ramp up your cash value so it can afford you can afford those cost of insurance increases that will inevitably happen. Otherwise, you're going to get the letter. Your cash value went to zero, and you're going to get the letter from the insurance company. You're going to be 85 years old, and they're going to say, hey, you know what, Mr. and Mrs. Klein, in order to keep this $500,000 death benefit, you need to give us $30,000. And you're like, what the hell are you talking about? I've been paying $2,000 a year on this policy for 50 years. What do you mean I owe $30,000? I thought it was a fixed premium. No, 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 no. They illustrated a fixed premium, and that's what you were paying along the way. But if interest rates go down and they're lower than initially was contractually illustrated to you, and or the cost of insurance went up because the insurance company raised the cost of insurance on you too. So not only is the cost of insurance going up because of your age, but the insurance company at any point in time can change the game on you. They could say, hey, you know what? There are, guarantee wise, we can come to the state insurance commission and petition for higher costs of insurance. And they could do that to you. They have those contractual rights. Not saying it's likely, but they could do that to you. And so, not saying universal life is bad, but what I'm saying is a lot of these policies that you may have out there, if you're around 55, 60 years old, those were illustrated in the 70s, 80s, maybe 90s with really high interest rate assumptions, and those guarantee that they did not live up to the assumptions. So if you want to continue that policy for the long term, you need to really reevaluate. Otherwise, you're going to get hit with this big bill later on in retirement, and you're probably not going to want to pay that. You're probably going to want to let it lapse because you don't want to pay $35,000 to keep a policy going, because that is not going to just be due that year. It's going to be due for the rest of your life. It's basically that's going to be the new premium you need to pay to keep the policy afloat. So if you have a universal life insurance policy, it's not a set it and forget it. It's one of those things you have to continue to reevaluate over time. All right. Now, like I said, I'm in the next video. I'm not going to do this today, but the next video, or actually I may record that here today, maybe tomorrow, but in the next video I do on life insurance, I'm going to break down the different types of whole life insurance. I'll break down the different types of universal life insurance policies. I'll talk a little about the hybrid policy and just my general thoughts about what type of permanent life insurance you may want to own based on your facts and circumstances in retirement. But again, this is just focused on should you even have life insurance in retirement? And so what? Okay. So here's the deal. I did a podcast episode on this, I don't know, a year or two ago. And if you want to check it out, I believe it is episode, let's see here. I want to say it's 26. Come on, I should have had this prepared for y'all. Sorry about that. Episodes. I just want to give you the right info there. It is episode 26, seven reasons to own permanent life insurance in retirement. So if you really want more detail on that, dive into that podcast episode, the Planning for Retirement podcast. Of course, make sure to subscribe to this YouTube channel because this is the podcast YouTube channel, but this is where I do my fireside chats where I'm just breaking down a specific topic more in depth. But I broke down seven reasons, and I'm going to just quickly highlight these seven right here on this whiteboard here. So, why would you own life insurance in retirement, or why would you want to? Number one, probably the most popular one for the financial folks out there, is estate taxes. Okay. Now, the estate tax exemption is fairly high. It's over $13 million at this point in time, and that's per person. Okay. And so, what that means is if you pass away, and your net worth is under the federal estate tax exemption, the estate has no federal estate taxes due. Now it might have state estate taxes, okay, and that's possible. So you need to look up your state's rules. And there are several states where the exemption is $1 million, or sometimes it's $2 million. And so if your estate is over that, which many of you that's likely to be the case, you might have state estate taxes due. But for federal estate taxes, the exemption is fairly high. Now, in 2026, the Tax Cuts and Jobs Act is set to sunset. I've said this 1,000 times over the last few years. I'm just kind of sick of it. But basically, the Tax Cuts and Jobs Act is set to go away. But of course, if Trump gets elected, that ain't going to happen. He's gonna extend that out. But even if he doesn't get elected, we'll see who controls Congress. I think it's potentially likely that this thing gets extended longer, but we shall see. I think, some people want to raise taxes on everyone, and it just depends who controls the White House, who controls Congress. But the Tax Cuts and Jobs Act is going to sunset in 2026, and the old federal exemption was $6 million. Okay, so about half of what it went to back in 2017. So if your estate was over 6 million, then you're subject to federal estate taxes, which could be upwards of 40%. All right. So life insurance could be designed to provide liquidity to your beneficiaries tax-free so they can then pay the federal estate taxes on your behalf so they don't have to go through a fire sale. They don't have to go and sell the family business. They don't have to go sell the family farm. They don't have to go sell all of that amazing real estate that you purchased throughout the years. They can just use that liquidity from the life insurance death benefit and pay the federal estate taxes and satisfy it, and off they go. So that's number one. Number two is you may have a special needs beneficiary. So special needs. So generally speaking, if you have life insurance and you're going to use life insurance to fund your beneficiaries who have special needs, you probably want that to go inside of a special needs trust. That way they keep their federal entitlements like Social Security. So special needs trust, essentially what you would do is you just set it up like any other trust. You would go to an attorney, and if you have a beneficiary that has special needs, you probably want to go see an attorney anyways to figure out, hey, should I have a trust set up? If so, what kind of trust? And then figure out how to fund that trust. So go talk to your attorney if you have a special needs beneficiary. But a life insurance policy is a great way to fund the trust. And it's not a great way to fund it with a term policy because it's, again, going back to the statistics, it's 97% of the time you're going to outlive your term insurance. And so you want to have that policy as a permanent policy. So that's reason number two. Here's a big one. All right. Here is a big one. And these first two are kind of the needs. You probably need to pay the estate taxes. You probably need to take care of your special needs beneficiary. This is more of a want. Okay. So number three I'm going to put in here is you have a goal, whether it's primary or secondary, that involves leaving a financial legacy. My handwriting is beautiful. All right. So financial legacy. I mean, this is important to a lot of you. Okay. Now, I will say I've kind of noticed a trend the other direction. Okay. I don't know if it's the Die with Zero book by Bill Perkins, but I've definitely noticed a trend for the younger baby boomers and maybe the older Gen X that's on their brink of retirement now. A lot of them, they want to maximize spending. They don't care about leaving a huge legacy to their kids. And maybe it's because their kids are probably making more money than they are. They're in big tech. They're just getting these Google stock units vested on a quarterly basis, and they're probably making 500 grand a year. And you're like, what? I'm not leaving you money. You're fine. You take care of yourself. or hey, I've already paid, I put you through private school, or I'm helping helping my grandkids, your children with their college education. Like I don't need to leave a big financial legacy. Or hey, you know what? Maybe I want a gift during my lifetime. But for some of you, this may be really important. And we just had a conversation this morning with the client where this was a primary goal. They want to sort of go in this idea of protect principal. Okay, protect principal, live on the interest, live on the dividends, live on the cash flows, protect the principal. And the principal then goes to little Johnny and his kids. So what I find it's a big challenge is that it's a tough thing to wrap your head around spending any of your portfolio or spending a reasonable amount from your portfolio because you're so obsessed with wanting to protect the principal. And I'm not saying that's right or wrong, but I'm saying what oftentimes is a good solution for that is to own a permanent life insurance policy. And you say, you know what? I've got a $500,000 permanent policy that I know is going to be guaranteed to little Johnny and his kids. And, of course, we have our home. Our home is worth $1 million. And so that's going to go to him as well. So that's 1.5 million as a legacy floor. I feel pretty good about that. And Kevin, all the numbers we've crunched, it's pretty likely we also have $1 million left over in our portfolio. It's not guaranteed, but at least the life insurance is guaranteed. And that's this legacy floor concept, and kind of to free you up to spend down your own portfolio for your own enjoyment, for your own fulfillment in retirement. So keep that in mind. That solution has worked wonders for some of my clients that had this friction, this fear of spending down because they have these legacy goals, and this is a good solution for that. Oh yeah, big one, blended families, children from different marriages. And perhaps you have different estate planning goals. Maybe your spouse has two adult children and you have two adult children. And each of you have grandchildren from those adult children. And you're like, hey, I love you to death, in sickness and in health, but I don't want to leave all my assets to your kids. I kind of want to leave them to mine. But then we also have this idea of a joint retirement. So we're going to be kind of spending down our nest eggs a little bit. How do I make sure my kids get a legacy if something happens to you or I, or if one of us gets sick later on and we need care? What if we have to, raid in the portfolio? How do I make sure my legacy goals are taken care of? So kind of similar to number three is these legacy goals, this desire to leave a financial legacy, but for blended families, it's even more important because you may not have the same estate planning goals. And so solving for that legacy goal for one of the spouse or two or both spouses to satisfy those other legacy goals could really free you up to just enjoy retirement and stop thinking so much about the money. All right, what else we got here? Number five, replace income. Very similar to when you were working. You bought life insurance to replace income. So maybe this is pension income. Maybe this is Social Security, because when one spouse passes away, this surviving spouse will step up to whatever the higher Social Security benefit is. And if it was an equal benefit, let's say you were each getting $40,000 and one of you passes away, now the other spouse is just going to collect 40,000. Then maybe that does create a little bit of friction there. Maybe that does create a little bit of some concerns there because now that guaranteed income is cut in half. And so, and then the same thing with the pension. Maybe you have a military pension and you elected to skip out on any kind of survivor benefit to maximize the monthly payout. Maybe you buy a permanent life insurance policy to replace that lost income if you were to predecease your spouse, especially if it was early on in retirement in your 60s or in your early 70s. So replacing income could also be true in retirement as well. All right, what else we got here? Number six, I'm running out of space. Oh yeah, long-term care funding, LTC funding. Okay, so a couple of different ways to look at this one is there are policies, and again, I'm going to be breaking this down on the next whiteboard presentation, whiteboard fireside chat, is there are policies, life insurance policies that now have long-term care riders. And so essentially what that allows for you to do is raid your policy during lifetime if you have a terminal illness or if you have a need for long-term care and you trigger 2 out of the 6 ADLs, daily living activities. So that could be a reason to have permanent life insurance just because you can buy the rider for long-term care. And now you kind of don't have to worry about long-term care because you're like, hey, If I need long-term care, my life insurance policy is there to pay for my care. If I don't need long-term care, now I have my life insurance that's going to pay out to my beneficiaries tax-free to satisfy these other goals that you might have. Okay. Another way to look at it is simply the death benefit. Let's say you have a permanent death benefit on yourself and on your spouse. And you're like, hey, this is for legacy. But if one of us does need care later on in life, and we have to draw down the portfolio aggressively during a year or 2 or 3 years, we can do that confidently, knowing that this death benefit could essentially replace those assets that were spent down over that period of time, if that makes sense. So you can kind of use that death benefit as a replenishment of those assets that were lost from drawing down the portfolio for those long-term care costs. Try to pick a different color here. I don't even see. Purple. There we go. My mom's favorite color. All right, so number 7. This is probably the most controversial point on this presentation. Alternative asset class, okay? And this is what a lot of these life insurance cowboys and cowgirls are pitching out there is, the stock market's just going to crash, they're not protecting your principal, the stock market's going to go to zero. And so you've got these life insurance cowboys that are saying, hey, you can get these guarantees on your life insurance, it's never going to go backwards in value. And all of that's true, but what's also true is that capital markets have been around for hundreds of years, and I don't see capitalism going away anytime soon. So I'd rather bet on the U.S. stock market than betting that it's going to fall. Okay, but to each their own. With that being said, though, for you retirees that are approaching retirement, maybe you're 50 to 55, and maybe you have this mindset. You're like, you know what? I've been taking a lot of risk. I've been taking a lot of risk with my investments in my 401k or Roth accounts. And maybe you have a business and you've been taking risk in your business. Maybe you're a real estate investor and you've been taking risk investing in real estate for the last couple of decades. And you're like, you know what? It'd be kind of nice to have some safe money in retirement. And you know what? Bonds have been crap over the last couple of decades. I mean, you look at since '09 through 2022, interest rates were next to zero. And so even if you had a bond, it's a very high quality corporate bond or a US Treasury, you're probably earning less than 1% on that bond for a long period of time. But those bonds are nice. I mean, listen, when stocks crash, like in 2009, or 2008, when stocks were down 35, 45, 55%, US fixed income was positive 6%. So, bonds do serve a purpose, but then you kind of fast forward to the next major bear market, 2022. All right. And at this point in time, you remember it because it's very recent, a couple of years ago, interest rates were sitting at next to zero post pandemic because, the interest rates were cut again because we're entering in a global shutdown. But then in 2022, or late 2021, I should say, Powell came out and said, hey, we're going to start to raise interest rates. Get ready. All right. Well, what happens when interest rates go up? Let's do this on another whiteboard. Here, the value of your bonds actually go down. And why is that? All right. So you think about it. Okay. If you have, let's say you have a bond. Let's look at today. Let's say you have a treasury bond, a U.S. treasury bond, and your coupon rate is 4%. Okay. That's where it's at now. And let's say it's a 10-year bond. Okay. Well, let's say Powell starts to cut rates next month in September. And now a new investor could come in and buy a new issue or buy a new issue at let's say 3%. Well, guess what? The value of your bond is now higher because your bond is more valuable. Who would ever want to buy the same risk maturity of a 3% bond if they could buy your bond at 4% unless they had to pay more for your bond? Well, the same is true on the reverse. So if you had a bond, let's say that was crediting 1%, back, let's say in 2020, let's say you had that in 2020 and it was also a 10-year bond. And then interest rates went up, by the way, over the last few years, as we all know. And now someone off the street can buy that same risk bond for 4%, also 10 years. Who was going to buy this one? Nobody, unless you discounted the price. That's why the price is contingent on interest rate fluctuations. And that's why in 2022, bonds were down 12 or 15%. It's because interest rates skyrocketed over that 18-month period. Okay, so back to this alternative asset class. that's kind of nice to know that, life insurance doesn't go backwards in value. Once you lock in each year, once you lock in that cash value, assuming it's not a variable life insurance, that's a whole different animal. And maybe we'll break that on the whiteboard. But as long as it's not a variable life policy, every year the interest is going to compound on top of the previous year. And so it could serve essentially as a bond alternative for those of you that are approaching retirement, but that also have enough time to build up the cash value. This can take a decade or more. All right. So if you're 65 and you're on the brink of retirement, it may not be viable for you. But if you're, let's say, 50 and you've got another 10 years of working, you could probably max fund a policy for 10 years, assuming it made sense for you, assuming you needed or wanted permanent life insurance. Maybe you had, maybe you wanted to cover estate taxes. Maybe you have a special needs trust. Maybe you have a financial legacy goal, or blended families, replacing income, long-term care funding, whatever the need or want for permanent life insurance is. If you need it or want it, then you could use the cash value as an alternative asset class, but never lead buying life insurance for the cash value benefit because you're paying for the cost of insurance. If you're going to just want to invest your money and you don't need or want permanent life insurance, you're much better off looking elsewhere because you don't need or want to pay for life insurance costs, do you? If you don't need or want life insurance. So that's my plea to you is start with the need or want for the death benefit first. And if you check one of those boxes and then you could use it as an alternative asset class, so be it. I'll just tell you how I've used it, okay? Back in 2016, my wife and I were buying our first house. We were looking for funds to pull from to buy our home. I didn't really have a ton of savings back in 2016, but I had a lot of money in my life insurance policy, remember, because I was funding that thing like crazy, $1,800 a month for several years. So I was able to take out a little loan for my life insurance policy and help with a down payment for 2016. We still own that house and we're using it as a rental. It's been one of the best assets on my balance sheet to this day. If I didn't have life insurance cash value, could I have pulled from it? Probably not. Fast forward to 2020, market dipped 30 to 40% in a very short period of time. Well, on my wife's birthday, March 23rd in 2020, I said, you know what, babe, the market's dropped so much. I don't even know. Our time horizon's so long from now. All I know is we're probably buying it at discounted prices if we put more money in the stock market today. Where do I pull from? All of my portfolio was aggressive high risk investments. My investments were all falling, except for one thing, my cash value life insurance. So guess what? I took a little loan out of that thing and I just plumped it in a bunch of equities, high quality US equities and index funds. And that thing just destroyed from a return standpoint over the next year. And guess what? That helped me fund my business startup costs. All right. So I probably I wouldn't even be here if it wasn't for my life insurance cash value. So, these are just a couple of ways I've tapped into it along the way. And I plan to continue to do that for the rest of my life. I just see it as another asset that's on my balance sheet. It's kind of like a savings account I don't really pay attention to. It's not my savings. It's not my emergency fund, but it's another savings account that's never going to drop at the stock market. So it's kind of like my opportunity fund, So if we have a real estate crisis, guess what? I might raid that cash value, looking to buy some properties, maybe buy a flip, maybe buy a rental, maybe buy a burr, or maybe buy some equities, who knows? And so for you retirees that are nearing retirement, you could do the same thing, use it as the safe money in retirement. So if stocks are falling and you need income during one of those years, you've always been trained, you want to be buying low, selling high. You don't want to be selling low. And so ultimately what you could do is you could tap into that cash value during those periods of time to let your stocks rebound and then rebalance that portfolio. But it is a little bit more involved, no question about it. It's a little different than, hey, I sell some bonds and buy some stocks, or I sell some stocks and buy some bonds. It's a completely different animal. It's a completely different account. It's in an insurance contract, so there's some complexity there. That's why I say I never lead ever with cash value as the goal of a life insurance policy. It's always the secondary benefit of permanent life insurance. So I hope you found this helpful, guys and gals. If you did, make sure to subscribe to the channel, of course. Make sure to share this with somebody who's approaching retirement and maybe fits one of these categories that we talked about here. And of course, make sure to follow the podcast on YouTube, of course, and at Spotify, Apple, wherever you consume podcasts. And we've got some really good stuff coming up. So I appreciate all of you. Until next time, Fireside Chat, Whiteboard Fireside Chat, Kevin Lau out of here.